Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation, and needs. Welcome to another round of market updates. Today we will cover various data releases, tensions in the Korean Peninsula, Bank of Japan developments, and commodity markets. To the UK first, construction PMI came in at 46.8, below the forecast of 49.2, and below the previous 48.7. New businesses engaged by UK construction companies fell for the 10th consecutive month in March, making it the longest period of decline since 2008 to 2009. Looking ahead, construction companies forecast a rise in output over the coming year, pinning their hopes on the recovery of capital markets. To the US, ADP private sector employment added 158,000 jobs in March, below the expectation of 203,000. Additions have been decreasing since November, hitting a high of 276,000, the highest number of additions in a month since March 2012. The data highlights that although jobs are being added, it is far below expectations and ties in with the slowdown in manufacturing and production. The ISM non-manufacturing PMI also expanded, coming in above the 50 threshold with 54.4. Although it is below the expected 55.9, the data again goes to show that whilst things are picking up, it is falling below expectations. Prior to this, the S&P 500 closed at record highs, but fell a surprising 18 points to close at 1553. Meanwhile, North Korea has beefed up its threats against the US, citing that it has approved plans authorizing counter-reactions against US aggression. The US, in its show of deterrence, has deployed a missile defense system to Guam as a precautionary move against North Korean threats. Evidently, both sides have been playing way too many Call of Duty video games, if you ask me. The markets have so far shown no reaction to the tension. In FX markets, the dollar-yen popped in intraday trading as Governor Kuroda went all-out Ninja Warrior and announced that the bank will merge its asset purchasing program with the regular bond buying program, essentially stamping his authority on the markets. The program will see the central bank buy 7 trillion yen or $746 billion of bonds a month. Kuroda also assigned a time horizon of 2 years to achieve the elusive 2% inflation target. As a result, the yen was hammered all the way up to 96.4, up from the open at 93. In commodity markets, silver and gold continued its slide recently, with silver trading below the $27 level, while gold fell below 1563 support. Having a look at the relationship between inflation and these metals, there is an argument to suggest that these variables are co-integrated, which means that they tend to crisscross each other. However, there has been a disconnect of late between the metals and inflationary expectations. Gold and silver have largely been correlated, and the disparity between the metals and inflation expectations have widened throughout 2013. If co-integration was to hold true, then the metals would gain as inflationary expectations fall. And if correlation holds, then the metals would gain together with increasing inflationary expectations. Now, the gray area here stems from the fact that inflation is a rate of change as opposed to an absolute measure, and the degree of correlation or co-integration affects this relationship. Movements between gold, silver, and the US 10-year break-evens depict exactly this relationship. Now, if the crisscross relationship holds, then we expect the metals to rise up towards inflationary expectations. The inflationary effect on gold is what would cause it to move together with the S&P 500. However, our long-term view is that the fundamentals supporting gold upside is still valid. The increase in money supply and the pending rise in money velocity could subsequently lead to increased price levels, given the Fed's asset bubble and their holy grail policy of Keynesian monetarism to fuel growth through inflation. That's all for this week. Good luck and happy trading. Thank you.